Hi, I'm Tom Stimson and welcome to AV Matters. Today we're going to talk about a very exciting topic, credit cards. Credit cards are part of who we are in society today. You pretty much can't go to Starbucks without pulling out a credit card. We've become a fairly cashless society. But I get calls from owners and business managers all the time asking me for strategies so they don't have to take credit cards from customers anymore so they can save the 2.5% credit card fee. Okay, 2.5% is a lot of money, but cash flow is really important as well. I want you to think about cash flow before we actually answer this question about credit cards. Cash flow is your expense for doing business. How you manage your cash flow is your problem, not your customer's problem. But on the other hand, if the customer is asking you to be their bank, that does become your problem. So you're not a bank, but you can charge for banking services when you perform them. Now, what some people want me to tell them is it's okay to charge a fee to a customer when they decide to use a credit card. And unfortunately, the way our society works now, that's a fairly offensive solution. So we've got to find another way of looking at this where it's practical to take a credit card without punishing the customer for doing it. Credit cards are for cash transactions. That's the thing that we need to understand and convey to our customers. They're not for finance transactions. So to put it in your terms and conditions world and how we're speaking to our customer about what the expectations for payments are, a credit card for anything paid in advance or paid on delivery is as good as cash. Now, you still have the issue that it's going to cost you 2.5% more, and you'd probably rather they just hand you a check or a bucket of money. But the fact is, cash in hand, whether it's from a credit card or a bucket of money, is still worth more to you than cash 30 or 45 or 90 days later. So anytime that you can get paid up front in advance or COD, you want to do it regardless of the transfer mechanism. So for those transactions, you can take a credit card seamlessly, and it's not going to affect your long-term financial viability. In order to get to this point, terms and negotiations are critical, because what you're telling me and what you're thinking right now is that, yes, we tell our customers that credit cards are great in advance, but then they turn around and want to give them to us at 30, 60, and 90 days. You have to build this into your terms and conditions. You have a cash price, okay, and you have a credit price. The credit price is you want 30 days terms, that's credit. That's extending credit to a customer. This is why we do credit checks for customers. So if you're going to extend credit to a customer, it's reasonable to expect payment for that credit. Goodness knows your bank does. If you have to finance that through your line of credit, you're going to pay interest on that. Now, we don't have to be petty and opaque and tell our clients exactly what we're charging them and what the finance rate for those 30 or 60-day terms really are, but we can build in discounts for cash payments. And a discount for the cash payment is actually a finance charge for terms. The final thing to think about in this credit card discussion and learning how to absorb credit card fees and make it feel like you're not getting the short end of the deal is to always start with the cash upfront term. So here's what a job is worth or what a project is worth if you pay me in advance. And while some organizations will balk at paying in advance, many of them are actually set up to do it. And the way they're set up to do it is with credit cards. So if procurement has to pay you now in order to save money, they're probably going to do it with a credit card rather than a check. And even if they are going to write a check, if they can save 3% or 4%, most procurement departments are charged with taking that savings and paying in advance. So as long as you're very clear about expectations and what the cash price is up front versus the terms and conditions price over time, you're going to do a better job of absorbing these credit card fees that you find so frustrating. And when the customer comes back and wants to pay you in 90 days, they're going to be paying you with a credit card on a value that's much higher than they would have paid you if they'd paid you at the beginning. So make sure that your proposal and your terms and conditions reflect the fact that sometimes you're going to get paid late and you're going to get paid with a credit card. So take credit cards, but be smart about how you ask for the money. I'm Tom Stimson. Thanks for watching.